Current lending environment, one word is challenging, and that's really because there has been a dramatic slowdown in transaction activity. And when I talk about transaction activity, I'm talking about sales, buying and selling of commercial real estate, which is what we lend upon. There's two ways that you're going to finance. You're going to refinance somebody who has to pay off a mortgage and they're keeping the property and they simply need a new loan, or they're going to buy a property and have to go out and get a mortgage. And because there's been such a dearth or slowdown in transaction activity on the sales side, there's less transactions to work on. And that's really just a function of the fact that we're in a higher interest rate environment. We're in an economy that still has its challenges. We have issues in commercial real estate where values may certainly have softened, and that makes it challenging. Now within that, there's opportunities, and there's opportunities for lenders such as Seven Hills to provide capital for those transactions that do work in this environment. Certainly multifamily is probably the most liquid market that's out there, or the most liquid property type from a financing perspective. Much of that is driven from the fact that we have the government-sponsored enterprises, Fannie Mae, Freddie Mac, and you have HUD providing liquidity and a backstop to that industry. That's also the most coveted asset class from the investor pools. There's more investors that want multifamily than want any other type of commercial real estate. So you have a depth there. Industrial still is an active property sector for investment. There's some headwinds there with slower absorption, but the long-term prospects for industrial remain quite strong. Other product types, grocery-anchored retail, neighborhood retail, necessity-based retail has performed very well over the last several years. It continues to perform well and continues to have quite a bit of investor demand. The lenders that are thriving in this environment are investor-driven lenders, non-bank lenders. The banking community, in particular the regional and community banks, are overburdened with commercial real estate loans. Oftentimes more than 50% of their loan book, if not more, is commercial real estate. With those banks experiencing trouble, somebody has to come and kind of fill that gap, if you will. And so we're seeing lenders such as Tremont will come in there, or debt fund lenders or securitized lenders. The CMBS market has come back in a big way in the last 12 months. We're seeing investor demand for the bonds for that. So it's things that are investor driven, non-bank, non-regulated. There's opportunities in every sector. It's uncovering that opportunity that's our job as a lender. Multifamily remains strong. We as lenders like that product type. We understand the long-term demand that is there for that, the long-term need that is there for that, and the economics. It's a property type that we certainly want to lend into. Tremont, we're well capitalized. We have investable capital to put into the marketplace right now. The relationship with RMR continues to give us just a tremendous wealth of knowledge for us to make very thoughtful investment decisions. And Tremont Really Capital really hasn't had that many significant issues, allowing us to remain on offense rather than constantly playing defense.